Good day, everyone. My name is Jeff Feinstein, Managing Director at Pinnacle Partners, and we are very pleased that you're joining us for yet another installation of our Private Wealth Strategies series. These are thought leadership pieces, small vignettes on a variety of subjects. We've had previous discussions with top tier RAs on harvesting of gains from concentrated low basis stock positions, the sale of a business and how that can be used. The realized gain can be used in combination with opportunity zone investing. And these are really kind of tax aware strategies. And it's our objective to bring to you, the individual investor, and our RA partners, a unique point of view on the emergence of a growing number of tools and techniques to minimize tax, shield tax while harvesting gains. And with the market yet again at highs and crypto now top ticking at 125 today, this is quite topical. So, what we're going to talk about today is the combination of opportunity zone investing with tax loss harvesting strategies. Increasingly we hear of these solutions, AQR being one, Eaton Vance another, that are being implemented with individuals that are participating, say, in the crowded Mag 7 trade. They could be founders in a recently IPO'd business, again, a low basis concentrated position, or anyone, frankly, that has seen substantial appreciation in a public equity and is seeking some sort of tax efficient sales strategy and diversification strategy. So we didn't have to go too far to find a resident expert, and that's John Menefee, a leader in our capital markets team and formerly of Eaton Vance, and I'll let JB introduce, aka JB, introduce himself, but he spent a lot of time, early days, pioneering tax loss harvesting. I think that the market is exploding at the moment, and we are seeing an increasing number of advisors and individuals, again, pairing tax loss harvesting strategies, emphasis on loss, alongside an OZ investment. As you recall, an opportunity zone investment provides extraordinary tax benefits unto itself when you invest a realized short or long-term capital gain. Within 180 days of that gain, you qualify for deferral of the tax on the gain. You get to enjoy the use of depreciation without recapture. And then finally, all the appreciation in the underlying real estate investment becomes tax exempt over a 10-year holding period. So a very powerful tax advantage solution that we have built a substantial business on. And now we're seeing some more sophisticated alternatives and pairing of those alternatives. And that is the subject of our conversation today. So with that, JB, why don't you provide a brief bio of your background, and then we can move right into this interesting pair trade strategy.
Yeah, thanks, Jeff. So, as you touched on very briefly there, my background, I started it with Parametric and, was a subsidiary of Eaton Vance, but they were one of the pioneers in this direct indexing space that, was this portfolio that would give you a market-like return with some tax loss harvesting over time. But this long short portfolio that we're going to talk about is essentially an evolution of that direct indexing SMA. And the reason it's an evolution is because it basically is a more flexible and durable loss harvesting engine as opposed to, a long only portfolio. Because within a long short, if we take a step back at a very basic level, you're going to have a portion of your portfolio that's long and a portion that's short. So when the market's appreciating, you'll be able to harvest losses in that short portion of the portfolio, and then vice versa, in different market environments. Whereas in a long only, you're only able to harvest losses when the market was falling. So you just have more room to be able to harvest losses over the course of that portfolio. And as you mentioned, I worked with several other different vehicles. The exchange fund's a very powerful vehicle, but that's essentially a deferral vehicle. When we look at what's, this combination of OZ and these long short portfolios, You do have a deferral element with opportunity zones, but you also have the opportunity, for lack of a better term, to potentially eradicate a significant portion
Hmm.
of that capital gain via the tax loss harvesting engine of the long short portfolio. Estimates vary, but I think, to use one provider's example, I won't name them, they said something to the tune of 10% of the total portfolio value that you can accumulate in short term capital losses on an annual basis. So if we use an example, like our new OZ regs, which allows for a 5-year deferral period, over that time period, there's potential opportunity for you to realize 50% of the portfolio value in short term capital losses, which is incredibly powerful and could go a long way to whittling down your original gain while also giving you that market like return within the long short portfolio and that tax free appreciation on your opportunity zone investments, in addition to some of the tertiary benefits that you touched on through bonus depreciation or for depreciation without recapture, et cetera. So together the way we're thinking about it is this really is a complementary multi-year tax strategy that helps investors keep more of what they earn while still earning that market-like return and a well-diversified portfolio with some scope for customization.
Excellent. And maybe, JB, can you give us some illustrative example? I'm an early NVIDIA employee, low basis stock, a run to recent highs. I take an investment decision, likely with my advisor's guidance, that I want to harvest 50% of my holdings in a tax efficient way. I'm also desirous of diversification into real estate. I think, market timing's good to get it to increase exposure in that category. So what's the kind of the practical implementation of a strategy like that?
Yeah, so as you mentioned, when you're thinking about that diversification event, you're going to have a portion of your investment that's your cost basis, and a portion of it that is your eligible capital gain for reinvestment into the opportunity zone vehicle. So when we think about that, we think this is a perfect use case for pairing the two together because, on the one hand, you get to take that capital gain investment, put it into your OZ strategy, defer that capital gain through the deferral period, and then upon the end of that 10-year hold, experience the tax-free appreciation of that investment. While along the way, you take that cost basis that you have from the original sale of that position, you put it into your tax loss harvesting SMA. There you have your core equity exposure. You're getting your market-like returns. But on top of that, you're generating losses in that portfolio that you're using to help offset the original gain that you incurred when you sold that position. So there's an element for significantly reducing or an opportunity to significantly reduce that capital gain that you owe through that deferral period while also earning a compelling return in a great real estate product and also getting your market beta via your long short portfolio.
So just to again take it down to one level of detail associated with the deferral. So we'll take an opportunity 2.0, and I'll suspend the definition of 2.0 for the moment, but say I'm entitled now to a 5-year deferral of capital gains tax on the sale of my NVIDIA stock. So I get a 5-year deferral, like an interest-free loan on that tax otherwise paid. I establish basis at the pre-tax value in the underlying real estate investment. I also, by the way, in this scenario, I do enjoy on the after 5 years a 10% discount in the tax owed, the deferred tax owed. In addition to that 10% earned by the Opportunity Zone program, I can take losses harvested and further reduce my mitigated tax obligation. Is that correct?
That's correct. So one important to know about carrying over tax losses is that you can build those up and roll them forward into the new
Hmm.
year over time. So in theory, Jeff, you could accumulate, let's say for instance, the portfolio assumption is something where you could generate 10% of the portfolio value on an annual basis and losses. So if you have a $1 million investment and you have $1 million capital gain that you've realized and you have the deferral period for 5 years, over that 5 year period, you could potentially offset a significant portion of that by your loss harvesting portfolio and doing so while also capturing that market like return within your equity investment.
And then to continue on the OZ side of the pair trade, I've now reduced the deferred tax that was, and I've further mitigated that obligation over time using this alternative strategy, this companion strategy. I'm tax efficient within the investment, the OZ real estate investment itself, because I get to use depreciation throughout the holding period without recapture, which is really big. So any income that is generated from the OZ investment really is extremely tax efficient and netted out against depreciation. And then, of course, at the terminal sale of the real estate asset, assuming I qualify for tax exemption, I pay zero capital gains on that appreciation. So if 1 million went in and became worth 3 million, hypothetically, the the 2 million in appreciation is tax free. So just a little bit more on the OZ side of that trade. Anything more on the tax loss harvesting side of the trade, JB?
Not on that side, but I think maybe if you just allow me, Jeff, what we want to talk about next is more so, how should advisors be thinking about this strategy? Because I
Yes.
think it's quite easy to bucket it into simply just this interesting, unique investment strategy rather than a driver for growth within your practice. So, I mean, when you think about what occupies an advisor's day on a day-to-day basis, I'm I've not been an advisor, but I'm willing to bet that it's one of two things. It's new business development or it's client retention. So from a new business development perspective, this is a powerful way to differentiate yourself with prospects by bringing to the fore this vehicle that marries investment growth and tax efficiency and allows you to unlock capital gains from these prospects to bring them into your practice. And from a client retention perspective, it's the very same exercise, but essentially you're going back through, you're combing maybe some of these tricky assets that your clients have had in the past. You're able to unlock those, you're able to help them diversify, and you're showing them that you're being proactive by bringing together tax sensitive strategies to help them get a better overall return and a better, more diversified portfolio.
Very, very good. Thank you for that, JB. And maybe just to paint the landscape for us, obviously Eaton Vance still very much a leading provider, but can you speak to other solutions that exist, AQR and
AQR, I believe, were one of the pioneers in the long short space. Quantino is another name out there. Gotham, as you mentioned, Eaton Vance and Parametric, Aperio and BlackRock. It's really becoming some of a ubiquitous vehicle within the tax efficient, separately managed account space, and something that's becoming more and more prevalent within the practice of sophisticated RIAs.
I know, JB, you've done some work with some of your RA partners to do analysis, hypothetical, again, illustrative examples of how you can bring these two strategies together uh, to get a significant tax advantaged return. Um, we would gladly do that for anyone interested. Lean on your expertise, of course. So I'm really pleased to have JB on the team, and we're engaging with a number of advisors at this time on this particular trade. Although we're not, dispensing investing advice, we certainly have some pragmatic tools and a point of view we're happy to share. So thank you everyone for joining us today, and look forward to the next installment of our Private Wealth Series conversation. Have a great day. Thank you.